Hello, and welcome back to our final video series dealing with managerial accounting. Chapter 13, we're going to look at capital budgeting decisions. Now, this is actually pretty important. Reason being is because a lot of you, hopefully, as you progress through your corporations, through your companies, and end up getting into upper level management positions, hopefully you guys will have to make some capital budgeting decisions. So what I'm going to do is just kind of run through the chapter relatively quickly, pointing out some of the important things that are covered in the book that I believe warrant a little bit more discussion, I guess, for lack of a better term. So let's look at capital budgeting, right? So when we look at capital budgeting, there's basically 5 types of decisions you can make, right? Number 1 says we're going to replace some equipment, right? We're going to spend a large sum of money on an a revenue producing asset, and we need to make the decision that, hey, we're going to invest large sums of money in this asset. Is it worth it? Should we replace this machine? We're also going to look at plant expansions, right? We want to expand our plant so we can produce maybe another product line, right? Or maybe increase production of the current product that we're making, okay? Also, too, lease or buy, right? Is it cheaper? And when I mean cheaper, I mean, is it more beneficial for us to lease a piece of equipment or a piece of machinery, or should we just buy it outright? And then obviously cost reduction. That's another type of capital budgeting decision that hopefully you guys will be making at some point in time in your career. We're going to go through, we're really going to get into the nuts and the bolts of how do we conduct capital budgeting decisions, right? We have 2 types of categories that are 2 types of decisions, right? Or topical decisions, I guess you could say, right? We could do a screening decision, or we can do a preference decision. Basically, we're screening our products, or let me rephrase that, not our products, we're screening our projects or the different types of machines that we could possibly buy. We're screening them against some standard that we have, right? We're going to be talking a lot about return on investment. We're going to see how to calculate return on investment. We're going to work with the net present value. So basically, when we do a screening decision, we say, okay, here's the net present value of this piece of machinery or undergoing this project. If that net present value doesn't give us a certain return, or we'll look at the payback period, if it doesn't meet some certain preset standard, for example, company says, you know what, any project we invest in has to have a payback period of at least 4 years, right? Anything more than 4, or I'm sorry, at the most 4 years. Anything more than 4, we're not going to invest in that asset or that project. That's what the screening decision is, right? Preferences, or making a preference decision, says, hey, we have a number of different projects that we could undergo. We need to find out what's the best project, what's the second best, and what's the third best. So when we're looking at preference decisions, we're ranking our decisions, or we're ranking our choices over a number of projects that we could have. And we'll see how to do that as well. Okay, so here's the main takeaway, right? We're looking at 3 ways that we can calculate or make the decision, is this a good investment? Should we invest in this project? Should we buy this piece of machinery? So we're going to look at the cash flow, the net present value, and the internal rate of return. Okay, so basically here we're looking at cash flow versus our operating income, right? And operating income includes some non-cash expenses like depreciation and things like that. So we have to look at just the operating income, okay? And basically these three methods that we have here really focus in on what is the cash flow of this project, right? We don't know what the future cash flows are, but we estimate them. So these are all basically estimations of capital investment projects, or let me rephrase that, um, um, projected or assumed cash flows with a capital project that we have. Okay, so again, we need to think about how exactly does this work, right? What are our typical cash outflows? Well, that's pretty simple. If we think about it, what do we spend money on, right? We have repairs and maintenance. We have to spend money to repair and upkeep the maintenance of our machinery. Yeah, that makes sense. Initial investment costs. Sure, that makes sense, right? We're going to start a project. We need to buy some new machines. That's an initial investment we have to put up front so we could start the process. Working capital, right? The book goes into a little bit of detail, and I think that's one of your study guide questions, if I remember correctly. You know, define working capital, right? Current assets minus current liabilities. That gives you your working capital. Incremental operating costs, right? We talked about incremental costs when we looked at decision-making process, right? And special orders. Should we do a special order? Should we not do a special order? Well, there's incremental costs. Same thing here with undergoing maybe a new project, or taking on a new project, or replacing a piece of machinery. There's going to be incremental operating costs. Those are our cash outflows. Inflows, well, that makes sense, right? What do we get cash for, right? Well, the salvage value. You should remember from financial accounting principles, the prerequisite to this course, what salvage value is. It's basically the value that we get from the machine that we sell, right? We're going to replace some piece of machinery. Well, presumably, hopefully, at the time that we go to sell this old machine, hopefully it has some value, right? We could sell it and maybe get $1,000 for it, or $500 for it. That's the salvage value. Okay. Any reduction in cost, that's going to be a typical cash inflow. If we release working capital, that's going to be a cash inflow. Any incremental revenues that we receive from a project or machinery is going to be a typical cash inflow. Okay, so the one thing that we really need to look at here is the time value of money, and I really want to make sure you guys understand this. It's not really that complicated. It's just a little, it can be convoluted, and we'll go through some examples of how to calculate the time value of money, especially when we look at net present value. But basically, I'm sure hopefully you've all heard the adage, a dollar today is worth more than a dollar tomorrow, right? And the reason why is because if I get a dollar today, I can take that dollar, I can invest it, and I can get interest. Okay? The slide says more than a dollar a year from now. I think conceptually that makes more sense, because if you think about it, a dollar today versus a dollar tomorrow, well, how much interest am I going to get overnight? You are going to get some. It's going to be minimal. But the point is, the sooner you invest, you rather have money sooner than later. Keep in mind, our prime example, if any of you guys have any ambitions, at least I know I do, of hitting the the Mega Millions or the big Powerball, you have a choice, right? You take the lump sum, or you take the annuity, the money over time. Well, I'm taking the lump sum. The reason why is I get that money sooner, right, than later. And the idea is I can reinvest that money at a higher interest rate than what that annuity is paying. So hopefully I can make more money on that. Okay, so that's the idea of the time value of money. So when you are looking at projects or um, thinking about replacing machinery or whatnot, you want to look for projects that give you the earliest returns. Okay, so if you have two projects and one promises earlier returns than the other, 9 times out of 10 you're going to want that earlier return. Okay, because that way you get the money sooner. The sooner you get it, the sooner you can make it work for you. Okay. Um, excuse me. So we're going to get into this idea of discounted cash flows. Okay, and basically what that is it takes into account the interest and the time value of money. Okay, so when we look at specifically the net present value, um, we're going to invest in a project. That project has future revenue cash flows, right? I'm going to buy a machine today, and that machine next year is going to give me, let's say, $1,000,000. The year after that, it's going to give me a million two. Year three, $1,000,004. Year four, $1,000,006, right? So I got those 4 years into the future. I want to know how much is $1,000,002 worth today. I'm going to get it a year from now, but what's it worth today? $1,000,004. I'm going to get it 2 years from now. Okay, that's great. I'm going to get it 2 years from now. But how much is that $1,000,004 2 years from now? How much is it worth today? Okay, that's what we're doing. We're discounting that cash flow. So payback period, probably one of the easiest things to calculate. Okay, basically all it does is focus on how long is it going to take me to recoup my investment, right? How long is it going to take for me to recoup that initial $1,000,000 investment that I put in so I could get get this project up and running? Okay, so how does it do that? Well, it's pretty simple. The payback period is the investment required, that's going to be your initial investment, divided by the annual net cash inflows. Okay, the payback method is quick and easy, right? I'm going to get my money back in 4 years. Okay, great. The only problem with the payback period is that it does not consider the time value of money. Now, hopefully you got the point that the time value of money is pretty important. So this payback method, a method that we use to analyze a capital budgeting decision, does not use probably one of the most important things that we need to consider, which is the time value of money. Okay, so why would we use it? Well, because it's easy to use. It's easy. It gives us an idea of here's how long it's going to take you to recoup that initial investment. Okay, definitely going to need to know how to calculate it. So if I were you, I might jot that, and it's actually one of the questions in the study guide. It says, hey, what's payback method? How do you calculate it? So there you go. That'll help you answer that question. So let's look at an example. Okay, management at the daily grind. We're bringing them back again. Remember the espresso bar? I think we talked about them in CVP analysis. Anyways, they want to install an espresso bar in its restaurant. Okay, cool. Well, two things we need to know. This is a capital project. How much do I got to shell out up front? Meaning, how much is it going to cost me to build this espresso bar? That's number one. Number two says, well, what are going to be my future cash flows? What do I estimate my future cash flows to be? Okay, so we have $140,000 outflow, and they think that this espresso bar is going to have a 10-year life. Okay, 10-year useful life, right? 10-year useful life, we use that for depreciation purposes, right? Two, they tell us that, hey, you're going to generate annual net cash inflows of $35,000. Now, what they're saying, these net cash flows, basically they're saying that, hey, you're going to generate X amount of revenue in the future each year. You're going to generate X amount of revenue. You're going to incur X amount of Y amount of expenses. You take the difference between the future revenues and the future expenses, and you got $35,000 left. So when they say net cash inflows, basically they're saying, hey, here's what we think the net income is going to be that we're going to generate. Okay. Now, remember we said beginning when we're making a scanning decision, we say, hey, we take our results of a particular investment and we scan them against some predetermined standard. Well, it says the management requires a payback period of 5 years or less on all investments. That's the standard. We want to compare this investment, and if we're not going to get our money back within 5 years or less, we're not going to invest in it. So what's the payback period? Well, it's easy. Investment required, 140 grand. Our annual net cash inflows, $35,000. Payback period is 4 years. So, based on a scanning decision, our payback period of 4 years is less than that predetermined standard of 5 years. It's an acceptable investment under those circumstances. Okay. Real quick, let's just take a quick look at this. Excuse me. Okay, so initial investment between Project X and Project Y. They both have the same initial investment. Cash inflows for year one are the same, $60,000. Cash inflows for year two is different, right? Project X gives me $40,000. Project Y, gives me $35,000. In year three, Project X has 0 cash flows. Project Y, however, has 25 cash flows, or $25,000 net cash inflows. Now, which one would you invest in? Well, if you look at it, you see that, okay, let me look at Project X. It's going to take me basically 2 years to recoup my money to invest in Project X, right? Year one, I get $60,000 back of the 100 that I invested. Year two, I get $40,000, okay? Project Y is actually a little longer than 2 years, right? Year one, I'm going to get $60,000 back of my $100,000 investment. Year two, I'm only going to get $35,000 back. So at the end of year two, I still have $5,000 of initial investment that I need to get back. So that's going to go into year three, right? So based on the payback method, we're going to choose Project X, okay? Now, if we go, let's look at Project Y. Notice when we use the payback method, we do not care about cash flows after the payback period. We only care about the cash flows that we get until we recoup our investment, and then we stop analyzing, right? Project Y is actually probably the better investment, right? Why? Well, think about it. Yeah, it's going to take me maybe let's say like 2 years and 3 months to recoup my investment, right? But after that 2 years and 3 months, this Project Y is still generating revenue for me. Project X is not generating any revenue for me or any future net cash inflows. Okay, so that's a drawback of the payback method, right? We already said, hey, it ignores the time value of money, right? We just saw that it ignores cash flows after that payback period. We saw that in that example, okay? Remember, shorter payback period, doesn't always mean it's a more desirable investment. Why? Because we just saw, hey, Project X stops providing me net cash inflows at year 3, where Project Y continues to provide me net cash inflow. Okay? Again, why do we use it then if it doesn't, if it has all these shortcomings and drawbacks? Well, like we said, it's easy to use, right? It's a good screening tool, okay? It gives us an idea of how long is it going to take me to recover that initial investment, right? Okay, so what do we do if we have paybacks with uneven cash flows? Well, this is actually relatively simple, okay? So let's look at a quick example, right? Let's say that we have a project that we're going to invest in, but those net cash inflows change from year to year, right? And in the real world that happens, right? Keep in mind, these are all future projections. We have no idea how much we're going to make, so we estimate, right? We guesstimate. So we guesstimated and said, hey, year 1 we're going to bring back, we're going to get $1,000 net cash inflow. Year 2, we have no net cash inflow. Year 3, we're going to receive $2,000 of net cash inflow. Year 4, $1,000. Year 5, $500. We got to determine what's the payback period. Guess what? It's easy. All you do is subtract, right? So let's look at an example with $4,000, and I'll show you what I mean. Nope. I'll show you what I mean. Okay. So bear with me here. Draw. Okay. So we have initial investment of $4,000, right? We're cool with that. In year 1, we get $1,000 back. Okay, so that means we have $3,000 left to collect. Okay, year 2, what's our net cash inflow? 0. We get no money. Okay, so at the start of year 3, what is the initial investment we still need to recoup? Well, it's still $3,000. Okay. Year 3, how much money are we recouping? We're recouping $2,000. So that means at the end of year 3, we still have $1,000 that we need to recoup. So we go to year 4. That initial investment of $4,000, we have $1,000 left to recoup. What's our cash flow in year 4? Hey, it's $1,000. At the end of year 4, we have recouped all our money. Okay? And that, my friends, is how you do the payback method with uneven cash flow. When we come back in our next video, we are going to start to look at the analyzing and investment using the net present value method. So we'll see how to do time value of money there. So please tune back for that one.